Well, today we're extremely privileged to have with us Dr. D. Subbarao, former Secretary Finance Government of India and also former Governor Reserve Bank of India, who took over as Governor RBI soon after the global financial crisis hit us in late 2007-2008. And hence, it was a baptism by fire, as he put it in his own words. But that makes him uniquely positioned to help us understand the present crisis and how best India can navigate it. Thank you so much, Dr. Subbarao, for speaking to us in ET Now.
Thank you.
Well, this is as close as you can get to a perfect storm, with mayhem not only in currency markets, oil markets, fear of a pandemic that has suddenly become very real, with the WHO declaring that it is a pandemic, slowing growth in Japan, which is already in recession, Germany, which is close to one. So are we really on the brink of another global recession, Dr. Subbarao?
Well, the world has been in the shadow of an impending recession for the last couple of years. The odds of a recession have certainly multiplied because of the proximate factors that you mentioned. Coronavirus all around the world, which has just been declared as a pandemic, the oil supply shock, the turmoil in the currency and other financial markets. So certainly the odds of a recession have multiplied. What's going to be different about this recession is two factors. First, it's going to be a China-centric recession. It's the disruption to production in China, which is transmitted all around the world and caused disruption to global supply chains. It's the destruction of demand in China, which is causing troubles for commodity exporters. So what's happening in China is transmitting around the world. We must remember that China today accounts for about 20% of global GDP and about 35% of global GDP growth. So what's happening in China is probably going to trigger the next recession. The second factor that's going to make this recession different is that this is going to be triggered by developments in the real sector, as opposed to other recessions over the last several decades, which have come about because of developments in the financial sector. Another thought in this regard, the IMF says that the threshold growth rate, global growth rate for a recession is 2.5%. And I believe we are quite close to that, so the probability of a recession is quite high.
Well, that's quite a dire picture that you're painting, Dr. Subbarao. So can we expect, or at least hope, for some kind of coordinated global action from global leaders, central bankers, on the lines of what we saw in the days immediately after the collapse of Lehman Brothers? Or is that really too much to expect when you have somebody like President Trump in the White House?
That a coordinated global action on the financial front, economic front, seems very unlikely, and for several reasons. In 2008 was a different situation when confidence in the financial markets was broken, and coordinated action had a lot of synergistic impact. Today we are having a problem, possibility of a global recession because of a supply shock. It's not very clear that stimulus by central banks or indeed by the governments is going to be the most effective response to this. The other reason we may not have coordinated response is what you mentioned just now, which is that America has not very active on its global leadership. And finally, central banks around the world do not have the firepower. So for all those reasons, I think coordinated global action is unlikely.
So in the Indian context, Dr. Subbarao, the RBI has already eased considerably in monetary policy, but the government has been a little bit more circumspect as far as fiscal policy is concerned. President Trump has just said that he would be speaking to the US Congress and seeking their approval for tax reliefs to small businesses affected by disruptions on account of coronavirus, and also some kind of a payroll tax. Should we in India also follow suit regardless of what fiscal zealots might tell us? Because these are very extraordinary times.
I don't think so. I think we've got to have our eyes on the radar of the macroeconomy. As much as the coronavirus is a realistic threat, we must recognize that it is a supply shock. A response by way of fiscal stimulus would come in or would be appropriate if there is complete demand destruction. We don't see that now. So I think we've got to wait and watch until see how coronavirus evolves in India and around the world. In fact, there might be some stimulus coming in automatically because of the oil supply shock. If indeed the government decides to pass on low oil prices to consumers, there might be some stimulus coming in there. So another stimulus on top of that might be unwarranted at this point of time, given the size of the pandemic in India and given our fiscal pressures. I think it'll be too early for a fiscal stimulus.
Except that if the government were to use that money and spend on building a hospital, maybe we'll kill two birds with one stone, have some kind of action against the coronavirus and also have government spending which will create demand. But having said that, the crisis has hit us in India at a particularly unfortunate time. We have slowing growth compounded by the weakness that we're seeing in the banking sector. What explains a spate of bad news on the banking front, cutting across both public and private sector banks, Dr. Subbarao?
Well, the banking crisis precedes the immediate environment today, which is completely overshadowed by the coronavirus, but certainly the banking is a big problem. And to understand the causes for this, we need to go back to the period before the global financial crisis. We need to understand that a problem is complex, as the bad loan problem cannot be traced to a single or a simple cause. If you go back to the years before the global financial crisis, we will note that the India growth story unfolded on the back of an unprecedented investment boom financed by an unprecedented credit boom. Those loans given during that period started unraveling around 2010. In popular perception, this is all due to crony capitalism. I believe there must have been some of that crony capitalism, but to attribute the entire bad loan problem to crony capitalism, I think, will be misplaced. There were very many other factors at play. For example, there was a lot of investment in infrastructure, which was an uncharted territory, both for our banks and for our corporates investing in infrastructure. Second, for infrastructure investment, indeed for a lot of other investment, investors made demand projections on the assumption that good times will roll on forever without recognizing that there would be business cycles. And then if you jog your mind back to that period, you'll note that there were Supreme Court orders, for example, cancelling coal block allocation, cancelling spectrum allocation, stopping mining. So those orders derailed or delayed a number of projects. And finally, we had what is derisively called policy paralysis. So I think the bad loan problem we are having today, we've been having for the last 4 or 5 years, is a consequence of all these factors coming together.
Yes, I agree, Dr. Subbarao. It is a combination of factors, but should some of the responsibility be laid at the door of the supervisor at the Reserve Bank of India? I know it's going to be a tough question for you to answer, but could better supervision have nipped these problems in the bud? In the case of the PMC Bank, we can say dual control could be advanced as a reason. But why could RBI do something more in the specific case of Yes Bank? Because the deterioration in health was well known for quite some time, almost 2 years. But RBI seems to have been slow to react. Would you agree?
No, I would not. I think that is a misrepresentation or mischaracterization of what really happened or did not happen. It's not as if RBI has been sitting idle for the last 2 years. They've done a number of things with regard to Yes Bank. Most importantly, they denied extension to a chief executive, which I believe is quite unusual. Second, they wrapped Yes Bank on the knuckles for not disclosing NPAs and not making enough provisions. They brought in a new management, and it is only fair that the new management be given adequate time to bring in capital. And we know all the things that happened in the public domain, but we cannot assume that things did not happen behind the scenes. There must have been a lot of things happening behind the scenes which we are not privy to. For example, I read somewhere that RBI could have asked the erstwhile board of Yes Bank to issue shares at a hefty discount. It's quite possible that RBI and SEBI, as regulators concerned with this issue, would have discussed. So we cannot assume that whatever we did not see did not happen. So RBI had done a number of things, both that we know of and perhaps had done a number of things that we do not know of. But I also want to tell you something. It's not correct to expect the government or the RBI to jump in at the first sign of trouble in a bank. That'll create a lot of moral hazard. Banks are to be given enough time to correct themselves. So I don't agree with your suggestion that RBI has been sitting idle for the last 2 years, or indeed that RBI could have done something much more.
No, I agree. I'm sure many things were happening behind the scenes, but at least publicly what we know is that the first sign of trouble surfaced at the end of financial year 2016, and action of denying the Rana Kapoor his extension came much later, only in late 2018. So that seems to be a long time, but I entirely agree with you. We really do not know the full picture really. But related to this is my next question. Is a part of this, just a part of this, due to the fact that the RBI in the past two recent years has been excessively focused on monetary policy, especially post-inflation targeting, with the result that supervision was somehow put on the back burner?
Again, I don't agree with your suggestion. It's not as if supervision and monetary policy are mutually exclusive functions of the Reserve Bank. The Reserve Bank has sufficient intellectual capacity, sufficient staff, and leadership potential to handle all the tasks that are under its mandate. So to suggest that in its obsession with inflation targeting and monetary policy, supervision has been neglected will be completely wrong. I believe, in fact, I would say that it is the media which talks too much about monetary policy, which is excessively concerned about monetary policy, and thereby believes that RBI is too similarly acting in that way. I don't believe so. I think RBI's attention is divided across all its functions very justifiably.
Possibly, Dr. Subbarao. I agree. Today, these days, media, social media, with all this, there is much greater focus on many things which in the past nobody would have even questioned. But as with Global Trust Bank, a public sector bank, State Bank of India, has been asked to come to the rescue. The RBI's draft restructuring scheme, as it were, envisages SBI picking up a 49% stake in Yes Bank. Would a merger have been better, or maybe even nationalization? Because we have the case of the UK government in the context of the Royal Bank of Scotland. Why are we so scared? Because even in the case of the Royal Bank of Scotland, the UK government first took a majority share and subsequently they were able to offload it. But somehow we in India are so scared of that word nationalization that we'd rather do this and ask State Bank of India at great cost to its minority shareholders than government use taxpayer money directly. Dr. Subbarao.
No, I don't agree with that also. It's not as if nationalization is a completely benign option. If the government had nationalized Yes Bank, it would have become another public sector bank. And we know from our own experience that divesting out the public sector banks is a very, very difficult proposition. So I don't think we should get into expanding the public sector very lightly. So I do not agree with your suggestion that nationalization would have been a better option. About SBI merging Yes Bank, again, I don't think, but even minority shareholders, if SBI had merged Yes Bank, it would have had to take over all the liabilities. And I don't believe that that would have been a superior option. In fact, I think we should get rid of this tendency to go to SBI and LIC every time a bank comes under pressure. We should look at other options. And I commend the RBI for thinking of this somewhat novel option in our circumstances, which is some sort of a public-private partnership, getting in a reconstruction plan for Yes Bank on the back of the credibility and the financial strength of SBI. I think that's a good proposition, and I think we must give that a fair chance.
We must give it a fair chance, Dr. Subbarao, but the fact is that India, the track record of public-private partnerships has not been particularly happy. And in fact, the exact size of the hole in Yes Bank's balance sheet will be known much later, only when the bank declares its December quarter results. The expectation is that even with that 49% that SBI brings in, that money will not suffice. If that is correct, then how will we ensure that depositors' money is perfectly safe, there will not be a run on the bank? What can RBI really do to prevent that?
Yeah, first on your comment, let's hope that the public-private partnership in this case will be a greater success than our past experience. And now coming back to the results of Yes Bank that might come later this week. First of all, I want to say that RBI would have done sufficient due diligence. It is true that you and I and the public do not know the numbers that are going to come out on the 14th, but certainly the RBI does. So the reconstruction plan and the moratorium they have imposed reflect that knowledge and that understanding. Second, there is fear in the market, in the public today, that there'll be a run on deposits when the moratorium on Yes Bank is lifted. It's quite possible that there'll be heavy withdrawals, but it's also quite possible that there will not be very heavy withdrawals. If indeed depositors, the consumers, public, see that Yes Bank is able to dispense cash, and if there is credibility of the SBI-backed rescue plan for Yes Bank, it's quite possible that that will feed into a positive feedback or positive vibe for reconstruction of Yes Bank.
It all depends on how much confidence the public has in that restructuring program.
That's right. What I'm saying is that what will happen when the moratorium is lifted, and if indeed public confidence, depositor confidence in Yes Bank fills up or comes back rather rapidly, I believe that the plan will become more credible, more successful. About the RBI giving support, people are talking about some liquidity support at the central bank. RBI is the lender of last resort. If necessary, RBI might consider giving some liquidity support, but it may not be necessary after all. In fact, there are other channels for Yes Bank to get liquidity support. Indeed, SBI itself can give liquidity support to Yes Bank.
I do hope you're right on that, but as of now, at least the holders of Yes Bank's additional Tier 1 bonds have gone to court against RBI's restructuring scheme on the grounds that their claims cannot be subservient to those of the equity holders. And in case RBI sticks to these terms, will it mean curtains for the AT1 bonds of the country, or is it part of the maturing process on the market for such bonds? Because those, I understand, were the terms under which these bonds were issued.
Yeah, I have to disagree with you because what RBI has done or asked Yes Bank to do on AT1 bonds is consistent with the contractual obligations. I think some perspective is important. I know a bank has common equity, which is Tier 1. Then it has additional Tier 1 capital and Tier 2 capital. These additional Tier 1 and Tier 2 were brought in as part of Basel III framework after the global financial crisis. The logic is the following, which is that when a bank comes under pressure, the government should not be called upon to rescue the bank, because if it's the government that's called upon to rescue the bank, it is the taxpayers. So Basel III has built in a buffer by way of AT1, additional Tier 1 bonds, which is some sort of a quasi-equity and a bond in perpetuity, which is supposed to be providing a buffer and in times of pressure, provide an avenue for increasing your equity. So that's exactly what's happening. Some trigger point has been invoked. So the additional Tier 1 bonds are being written down consistent with the contractual obligation in order to increase the equity of Yes Bank. So this, I believe, is completely in conformity with the contractual obligation. You raised the issue of seniority, about whether common equity should not take the first loss. We must understand that this is not liquidation of Yes Bank. What's happening is a reconstruction. If indeed it is liquidation, you're right that equity must take the first loss, but that's not what's happening now. We must also recognize that the holders of AT1 bonds have gotten higher returns on the bonds. So for the higher rewards they got, it's only appropriate that they take the higher risk, and if the risk materializes, they have to bear the losses. Having walked into the AT1 bonds, all the contractual obligations, I think it's not fair for them to call for lenience on the contractual obligations.
I would agree with you there, except that many of them have gone to court because we always want to have our cake and eat it. But that's an important distinction that you made about liquidation and treating it as a going concern. But even so, Dr. Subbarao, could the fallout of the developments in the Yes Bank case have been better managed if the restructuring scheme had been announced simultaneously along with the announcement of the moratorium? Would there have been less panic among the depositors? Because in the case of GTB, Global Trust Bank, the moratorium was announced late on Saturday evening, and by Monday morning, the RBI had announced the merger also. also. And care was taken to ensure that ATMs and branches had enough cash. That doesn't seem to have been done in the case of Yes Bank. So is that something, a learning that we somehow missed out in the RBI? I'm sorry I'm using the word we, which goes back to my past days in the Reserve Bank of India, and I'm sure your loyalties there are there too, Dr. Subbarao.
Not at all. Thank you very much. But we must recognize that GTB was a different time, different proposition. Today, Yes Bank in 2020 is a lot different. So we got to see Yes Bank resolution and reconstruction in today's circumstances. So if it is true that RBI had come out with moratorium and the reconstruction plan the next day, if indeed they had come out together, you would have asked the other question, should they not have done it sequentially? So I understand that they had to impose moratorium first before coming out with a reconstruction plan consistent with a legal provision. So they could not have done it together. But there is also some rationale for doing them separately, first a moratorium and then a reconstruction plan, because it's quite possible that if they had both been done together, there would have been greater panic in the market. So I think we must give the benefit of the doubt to the sequential model that RBI has followed, which, as I said earlier, is consistent with the legal provisions.
Yes, I'm sure the RBI had its reasons, but at the end of the day, the fact is, Dr. Subbarao, that Yes Bank had a relatively large corporate loan book, unlike some other private sector banks that focus on the relatively safer retail lending. And the lesson from the recent development seems to reinforce the focus that retail lending is better. So, in the fact, the Yes Bank administrator also said that he's going to make Yes Bank a retail-focused bank. So, it brings us to the question that who's going to lend to corporates going forward?
I think that's a wrong question. It's not the responsibility of banks to lend to corporates. It's the responsibility of corporates to make themselves bankable. We must have a situation where banks, instead of corporates running to banks, we must have banks running to corporates, asking them to borrow from themselves. So I think to say that it's the responsibility of banks to lend to corporates is misplaced. Second, I must also say that as much as I have reservations on the consolidation of public sector banks going on right now, one of the objectives behind consolidation is in fact to make them large enough and strong enough to give loans to big ticket borrowers. So perhaps those merged, consolidated public sector banks will be in a better position to lend to corporates.
We're now seeing a huge sell-off by foreign portfolio investors as they rush to safe havens. Given our comfortable forex reserve position, should the RBI intervene more aggressively, or do you think we should allow the rupee to depreciate? Because at a time when exports are anyway not growing, we need every kind of support, including from a depreciating rupee, to try and prop up exports.
When I finished with the RBI, I thought I finished with answering that question, but I didn't know that that question would continue to chase me. To answer your question, the stated policy of RBI was, and I believe it still is, that they do not target an exchange rate, they only manage undue volatility, which is to say that RBI will allow the exchange rate to find its market determined level, but will engineer a trajectory of going to that market determined level to prevent or manage undue volatility.
Okay, yes, but it's easier said than done, really. But for us in India, we come to my last question, Dr. Subbarao. Low oil prices should be good news. Yeah. It is estimated that it will save us as much as at least US dollars 20 billion in foreign exchange. Will that saving and related improvement in government finances serve to offset at least some of the global and domestic slowdown? Wearing your hat of Finance Secretary of Government of India, how can we best take advantage of the low oil price?
Well, I'm not Finance Secretary to Government of India at this moment, so I can give more unconstrained answer. I have, of course, seen reports that the collapse in oil prices by as much as $30 is going to give a positive terms of trade shock of as much as 1.5 percentage points of GDP. That's a humongous benefit to us in these troubled times. So the decision for the government really is to whether pass this on as lower oil prices at the pump to consumers, or to tax it away and appropriate it to reduce vulnerability on the fiscal. That's a difficult decision. That decision will have to be based on a number of factors. The most important, of course, is how the coronavirus pandemic proliferates in India and around the world over the next few days and few weeks. That's going to have an important impact on demand. The second is global conditions and how that will impact on India's external position. As of last night, we learned that India has banned all visas, restrained foreigners coming in. Tourism will be impacted. All tourism-related sectors will be impacted. Therefore, that will to some extent offset the gains on the oil bonanza. And then there's the question of how quickly, if at all, the OPEC and Russia will settle this dispute on oil supply. So government will have to make a decision on how to distribute this unexpected benefit coming from lower oil prices between reducing consumer prices and taxing it away for benefiting the fisc. And my own view, if I was Finance Secretary, what I would advise the government is that as far as possible, take it for the fisc and don't pass it on to the consumers. Unless the pandemic intensifies markedly in India over the next few days and weeks and demand takes a hit, and at that time there might be a case for passing it on to consumers.
Okay, Dr. Subbarao, thank you so much for spending time and sharing your views on the global crisis and the crisis in the banking sector. It's always a pleasure to speak with you, and I'm sure you warm the cockles of the heart of both government by saying that don't pass on the benefits to consumers as of now, and also with the Reserve Bank of India by putting up such a strong defense of the Reserve Bank of India. It's very clear that your heart is still with the Reserve Bank of India. Thank you so much, Dr. Subbarao.
Thank you.